What's going on, guys? In this video, I'm going to talk about two intraday setups that I look for microcap stocks. It's been a while since I talked about microcaps, and the reality is microcaps aren't always hot. You can't always trade microcap stocks every day. Reality is, during June, July, and sometimes in August, there's a cold period during the new financial year where specs are pretty cold, typically. It's really hard to make 5 to 10% on any given stock sometimes, and when there's good news in that kind of environment, it tends to gap up too much for the news event and then it just sells off, which really sucks. So that's why I've been making content around mid-cap match scalping, and it's really a response to the fact that you can't trade micros every day. So I've been looking for an edge the last 8 months or so in the mid-cap space. I'm finding it really good for large catalyst news events. So when things really move hard, I find the book is super easy to catch the bottoms and tops and just riding momentum and stuff like that. So it's really great. Regular days on the mid-caps, I'm not doing so well. I'd argue my P&L is probably in the red on that. So I've kind of started to abandon that type of trading. I really want catalyst news events for mid-caps, or small cap, just typical small cap and micro cap trading where possible. So micros are hot again, so I want to show you guys the two setups that I do and some concerns I have around what people seem to think micro cap trading is. Now, I run a community of about 1,500 day traders. It's on Discord. Now, for those of you who don't know, it's just a live chat platform. You can find the link to Discord in the comment description below. It's a community I created. I wanted to get the best parts out of Hot Copper, Twitter, Facebook, and I wanted to get rid of all the bad parts. So really, this is the community that I've always wanted and the community that I'm proud of having. And what we have here, I mean, it's market close. It's 4:08 p.m. today on a Tuesday, and we've got still around 300 people online and active at the moment. So it's a huge community of 1,500 people, and we've got a lot of people in voice chat as well. Get a bit crowded, but if that's kind of your environment, it's quite helpful. So if you guys want to join that, great. I've seen some content on here during the day trade section during the day, and on Twitter and Facebook. Look, just everywhere in general. I'm concerned about particular setups that people are trading. So before I go any further, I just want to say I'm not a financial advisor, so don't take this as financial advice. Consider it an educational based video for entertainment purposes only. Also, I'm not recommending to buy or sell any stocks that I talk about today. Now, the first thing I see that concerns me is people trading micros that have just failed. Here's an example today, CI1. Gapped up, looked really good, fantastic. If you can match scalp that, good for you. But once I find that the previous closing price to the high of the day, once it hits 61.8% and doesn't recover like really soon after touching the 61.8, it's done. You've got high volume confirmation here that it's done. When I find this happens, it's 99 times out of 100, it's dead. All right. You can probably catch a bounce for a pip or two if you're a scalper or whatever, but I would never look at a stock like this again for the day. To me, it's done. If it recovers some sort of unicorn event, brilliant, I'll come back to it. But really, there are people that I've been seeing trying to catch bottoms here, like catching some sort of horizontals here at 8.5. Like, yeah, okay, you can get a pip or two if you really want, if you're lucky. If the liquidity there is there for you to exit, fine. But it's not good in any sense. Look at this stock. It just, once it sells off, it's done. So that's kind of my first rule. It's not a chart setup. It's just a rule that I have is once it breaks 61.8 or it doesn't bounce significantly off 61.8, it's dead. I don't look at it. It's useless. What's it going to do? Nothing. You can maybe catch a pip or two. Now, this first chart setup that I'm going to show you is gut-wrenching, and it will make you feel sick if you decide to do it, right? It's gut churning for me, and I've been doing this for years. So this is my favorite play of all time. I've been doing this since I started trading. And it's the 61.8% falling knife. It doesn't matter what the news is, doesn't matter what the event is. The condition is the Fibonacci starts from the previous day's close, which in this case is around 11.5 cents, to the high of the day. And the idea behind it is that when the stock rallies, just pumps up hard. This is from 11 to 81. This is a monstrous move. The drop has to be as fast as the initial run up. And if that happens, so pump into dump, the 61.8 is the entry, the 38.2 is the exit. Always. Now, in this circumstance, AQS was actually soared well above it, I think to the 23.6. This is an anomaly. It normally doesn't happen that it shoots so far above the 38.2. But this is the entry price that I get at 61.8. And look, there are going to be times, it's rare, but there are times where it pumps and just fucking dumps, right? It just crushes your position. Look, it happens. It's rare, but it happens. I find there's almost always a bounce. I can recall maybe 3 situations in my life where a stock has rallied and dumped and just never had a bounce at all. It just straight down and never recovered, never had a bounce, no nothing. I still remember those days, I still remember those stocks, and it's gut-wrenching, right? It sucks. Now, the reason I say this particular trade is gut-wrenching, and you'll see what I mean. If you ever find this chart set up in the next week or two, or whenever you decide to trade micros, or whenever you catch a chart set up like this, you'll see exactly what I mean. You'll see it come to the 61.8 in real time, and the bids will look disgusting. The order book will look disgusting. You might have a heavy sell stack just above the 61.8%, and you'll tell yourself, there's like a 4 pip spread, or there's not enough liquidity on the bids, it's just going to sell down. Like all these things will 100% enter your brain while taking this trade. It is a gut-wrenching trade. It's not for the faint of heart. For anyone who decides to look into this kind of strategy, this falling knife strategy, it doesn't happen very often, but when it does, I find it quite profitable. But you will see what I mean. You will have a very sickening feeling in your stomach, irrespective of what size you decide to put on. You'll feel like an idiot. You'll look at the book, you go, I should have paid attention to the book, and you'll probably get not trigger happy, but you'll get an itchy trigger finger to get out of the position. Even people I trade with know this. They know that feeling. They go through it, and they still get that itch to just bail on a stock. Even when it's recovering on its way back up, it'll still be met with resistance, and there'll be that urge and temptation. It's at the 50%. It's not recovering very well. The book looks terrible, and then just sell out. So this happened on AQS, MGL, and there was another stock. There was another stock today that someone caught that I didn't manage to trade. But this is another example. So I'm looking for the closing price for this one, and the 61.8. So 18th of February was 3. Here we go, 312 at 15 cents. Here's another example. This one overshot a little bit below 61.8. And this was because there was a trading halt as well. So this is kind of very unusual, is we hit this 61.8% level. So I got in at 3.7 with a couple of other people. And there was a trading halt as it hit 35. So it was really uncomfortable. There was like 1.3 million shares from memory that was trying to bail at the lows. That's where I just bought in more. I bought in on the auction and tried to catch it to 38.2. Now, there is nuance to this. In this particular instance, there was a strong reload seller here, bang on 5 cents. In that case, can't get to 5.3, bail out. This should be a sharp dip into a sharp recovery. If there's stagnation over multiple candles, it's probably done. This should be a very strong bounce. All right, it's a strong move up, strong move down, strong move back up. That's the idea. Any lingering, any hesitation, but do keep in mind that candles do have to form as well, right? It's not about, nothing's happened in 15 seconds, I got to bail, but we're talking about minutes here. So don't overdo it. And that's the only trade there is, 61.8 to 38.2. Where possible, right? There are circumstances where it overshoots, 38.2 undershoots the 61.8, circumstances where people reload, sell. These things can't be helped. But this is the strategy, is 61.8 to 38.2. This is by far the most difficult thing to execute. So I thought I'd put that strategy out there in case someone wants to look at it in the future, maybe wants to try and paper trade it perhaps, and just pay attention to it. But this is one of the best bounce play setups that I have for the microcap space. Setup number 2 is pump, consolidate, pump, stonks, right? This is a classic build to a parabolic move. In some cases, it might not be parabolic, but there are big shoots to the upside. Now, the idea behind this, and I've probably done poor choice of words with opportunity. Opportunity is the sell opportunity. The entry is consolidation. Now, I'm not suggesting in this particular chart setup that you can't make money elsewhere. That's not the idea. The idea is that once you identify, likely in the afternoon, sometime after 12:30 usually lunchtime is the consolidation phase. The idea is that a stock, when it pumps, and it makes another pump, doesn't matter how many pumps there are, but as long as the stock pumps and holds its value near the highs, that in itself is an indicator that there is no sell pressure remaining and that the stock is very likely to head to the upside. Now, what happens in this consolidation phase, you might be going, well, this looks like hindsight trading. Well, there's actually a lot of opportunity to spot the consolidation phase, right? That's what makes this chart setup so good. And in fact, when you spot the consolidation phase, you're like, oh, this basically is hindsight trading. You're just waiting for it to come to your entry price. For me, ideally, is I want the bottom half of the consolidation. If I'm late to the party and it breaks to the upside, that's also an entry as well. Getting in as early as possible before the break is my entry price should I miss the consolidation phase. You know, sometimes I might be waiting at like, what's this one here, at 39.5 cents. I don't get filled. It breaks the consolidation range on decent volumes. There's a little spike. Fine, I'll have to pay up. That's just how it is. Now, these things usually are followed through with volume confirmation, almost always. And that's where it breaks into new highs, breaks the consolidation range, and that's the opportunity, is to sell there. Now, there's also a little bit of nuance to this as well. You can see here, as it rallies, it does a pullback, and then there's usually a second wave. Now, there's not always, there's no like one size fits all in terms of rules of how much profit to take after a consolidation. You know, it's not like, hey, once it breaks consolidation, there's 15% profit to be made or something like that. That's not how it works. You got to mix in tape reading with this as well. So looking at where the sell pressure kicks in, the buy pressure stops. Usually it's the first bearish engulfing is the great sort of exit target, and then shopping around for when the reversal happens. And it's just basically a U shape every time. So when it starts forming a U, the volumes kick back in and swing to the upside. You can re-enter and just like keep it scalpy around that area. That's a really good chart setup for me. Pump, consolidation, pump is just standard. And here's another example I had a screenshot of. I've been tweeting this image alongside a bunch of stocks. Today was LEX. I can't remember what two stocks this was, but this was last week, late last week, sometime Thursday, I think it was. And it's the same thing. Pump, there's different consolidations happening in this one, but the important thing is that it's going up. And then, of course, the high volume break and confirmation. And you can see here again, there's a take profit target at 23. It pulls back and then it makes a second wave attempt. Now, LEX was a perfect example of this. What you'll notice in this screen cap here is these are low denomination stocks. You know, you've got 40 cents and 20 cents. LEX today was a little bit different. The consolidation was a little bit more like an ascending triangle instead of a horizontal, basically, a horizontal consolidation. This was more like a pennant, more like a flag. The range was getting tighter and tighter in just a different fashion. But the idea here is, and I want to make it very clear that a chart isn't about it's a pump and then it pulls back here and consolidates. That's not the setup. The setup is the rally into a very small pullback into a consolidation. And I didn't trade this one till the late afternoon because I wait till about 1:30. I like a chart setup. I saw people trying to buy around here, and look, once it broke the horizontal, fine, there's an opportunity there. For me, I was telling people I was going to wait for the pullback and consolidation. And here we have it. There's the pullback and consolidation. This didn't actually end up resulting in the sort of upwards, sort of parabolic pump move. So I just took profits along the way. It was around 71 cents, 70 cents, and I just waited for the next consolidation phase. You know, it looked a bit concerning here when it sold off, but really that, when you zoom out and you look at this, look how much it's pumped from 20 cents to 60 cents, and it's in context, this is not a big sell-off. This is tiny. compared to the overall range of the day, which is like 40 ticks. So what we have is another consolidation here. I ended up paying up at 67. I couldn't get the price that I wanted. I was looking for more like a range like this, perhaps a bit like this, more of a horizontal rather than a pennant. But this kicked off, volumes were coming in, and I just had to pay up at 67. And then it was just a matter of paying attention, and of course the first bearish engulfing, perhaps a little bit too soon. I didn't really manage to get a much bigger move. I ended up just scalping a couple of ticks because I'm aware of the fact that these things tend to, when they pump, consolidate, pump, is that they have a second wind behind them. Not always. This isn't like a guaranteed thing. I don't want anyone to think that, hey, if I catch a pump, consolidate, pump, I can definitely get a second wind. Nothing is a guarantee. This is just a chart setup that I look for, and it works for me. So there's your little dump. It starts doing a U shape. You can see it start recovering with volumes, and there's a re-entry. But this is, again, more scalpy, right? It's about riding the bigger momentum for me, getting in, waiting for the first bearish engulfing. I don't sell typically beforehand. I don't try and predict where the top is. I don't go, 84 and then sell. Picking the top is a sucker's game. You tend to give up profits a lot more than just waiting for confirmation, right? This, for me, was confirmation enough. Bearish engulfing, it covered the previous candle and the candle before that and almost the entire candle before that. So I was happy to get out at 82 when I saw pretty much high volume selling at the top of this candle all the way down to 82. There was a bit of a wall here. It was like a little horizontal from the previous candle here. And you know, once that heavy selling really starts to kick in, you can see it on the tape, right? There's plenty of time to react. There's probably about 15, 20 seconds to put in the order and close it out. I find that to be quite a fair bit of time. So it's worth checking the replay on this one as well. I found it quite interesting. But, you know, if you learned anything from this video today on chart setups for micro caps, please do consider hitting that sub button. I'd appreciate that a lot. Otherwise, leave me a comment below on what sort of setups you look for as well for micro caps. You know, this is just 2 setups that I look for out of maybe about 5 or 6 that I have, but these are the most profitable ones. One is super safe, which I consider this to be a super safe one, and the 61.8 is to be considered perhaps as the most dangerous one because the order book is just so trash, and you know, it'll give you that gut-wrenching feeling. So do leave a comment below if you have a chart setup that you like. I'd love to hear about it. Otherwise, guys, have a good one.